All right. What is up, traders? What's up, tycoons? Super excited for today's video. Really important one. We're going to cover what's going on in the treasury markets and the stock market. Bank of America, all right, has $40 billion in unrealized losses as Bank of America, Wells Fargo, and Citigroup face exposure to U.S. treasuries. Now, I've talked about this before. We'll dive into it a little bit more, but I mentioned how treasury yields are went much higher than they were, that caused the initial bank crisis due to treasuries. And we'll talk about that a little bit more. We'll talk about TLT, why I do have a short position right now in TLT. And one of the reasons is there's over 330 billion just that's disclosed. But to me, it seems more realistic that it's closer to $500 billion, aka 500 billion, to be auctioned off this week. We'll talk about what really moved the treasury markets, and also the treasury markets have a big impact on the stock market, and it was really a lot to do with Janet. Okay. And then we'll talk about the return of bond vigilantes. We're also going to go over the gamma squeeze that we saw in the market, just in case you missed my gamma video last week. All right, and then we'll talk about a rare signal that we've had and what it could mean potentially for S&P 500 returns. We'll break down the recovery time from market drops, and we'll talk about the call wall that we're facing in the S&P 500 that we really need to. It's going to be a big barrier for us, essentially. Of course, we're seeing bearish sentiment in U.S. Treasury still. All right, we'll break down the four pillars on a weekly time frame and also a daily time frame. Then we'll go on into some risk on and risk off ETFs that I've created here. And then we'll take a look at some defensive offensive measurements that I've created here as well. But as always, the content provided on this channel is just for informational and educational purposes only, and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. All right, I did start a completely free newsletter called Investment Intelligence for you guys, giving out free trade ideas just like this one. Once or twice a week, you'll get those trade ideas straight to your inbox, and you can see that this trade idea turned out very well. We also had a short idea over 2 months ago on XHB. This is the home builders, a very interest rate sensitive sector, and that sector ended up dropping over 18.5%. This was a short idea on SWK, Stanley Black & Decker, highlighting the rising wedge, highlighting where we think the price could come. And as you can see, a lot of these trade ideas have turned out very nicely. And if you've been subscribed to the newsletter and paying attention to these trade ideas, there's the potential that you could have made some decent money in the market. So if you're a fan of free, valuable finance content as well as free trade ideas, you're going to want to subscribe to the newsletter using the link in the description. If you want access to all of the different trade ideas, right? This is a profit screenshot from all the plays that I was in last week. Many of these actually sold for much higher profits. This was earlier in the week. All right, but you can see, basically all of the different trade ideas that I'm looking at if you join the Investment Intelligence Discord. Okay. It's only a couple bucks a week. All right, very cheap, very affordable, less than a cup of coffee, less than a thing of Starbucks every single week. And you don't have to join that. You can just sign up for the newsletter. That's completely fine. I'm still going to put out that free valuable content for you guys. And if you enjoy the free valuable content, you can head on over to my Ko-Fi page where you can click on the commissions here, and you can actually book a one-on-one session. Okay. If you want to book a 30-minute or a 1 hour session, get that one-on-one time and feel like you need that one-on-one interaction, you can book those sessions directly through the Ko-Fi page. You can also click on the buy a coffee button, basically as a way to leave a tip or a donation for the free valuable content I do put out. And you can request a specific YouTube video on the topic of your choice, all through that Ko-Fi page. So the links for all of that is in the description below. Let's get into today's video. And as I highlighted before, $40 billion in unrealized losses hits JP Morgan Chase as Bank of America, Wells Fargo, and Citigroup face exposure to U.S. Treasuries. Now, this should not come as a surprise, okay? If you paid any attention to the banking crisis related to Silicon Valley Bank and the other regional banks, it was all because of Treasury positioning, right? And their Treasury portfolios being massively underwater, and seeing these massive unrealized losses that caused bank runs, okay? And I've been pounding the table really ever since then. We've seen Treasury yields go much higher than they were at those levels. And if those levels caused, issues for the banks, it was really just a big cause for concern of, what interest rates at these levels were going to do. And I've been mentioning over the past couple months, over the past month or two, that I think it's possible we're going to see more bank failures, right? And actually, we just had a new one. We had Citigroup. Now, it's not the Citigroup that necessarily you guys are familiar with that's sorted here. It's the Citigroup of Iowa. So it's a smaller regional bank. They were just added to the list of bank failures. Okay. And we're starting again to see potentially more bank failures come, and it's a cause of concern. Now, this is the TLT 4-hour chart. I have been playing the shorter duration through SHY and then the longer duration through TLT. This is a short position here that I entered in on Friday. One reason is just from a simple technical analysis standpoint. We had overhead supply here. Okay, we established that zone, and we came back and retested it, put in a little bit of a double top, right? And so this was a healthy area where I was comfortable going short. You can see it fell dramatically afterwards. And these are going to be some of the price targets, looking at for the downside. I got the 88 puts when those were out of the money. And now those are in the money. We'll see if it breaks down further, how much longer I'm going to hold these. The expiration date isn't very time friendly on these. I don't have months to hold. So we'll see, basically how that trade turns out. But, it would make a lot of sense for me to, in my opinion, to see the bond market pull back. I mean, TLT just went from 81.92 all the way to 89.05 in a very, very short time period. And to me, it was a little bit of an overreaction. Okay, not only do we have some bullish divergence here, okay, you can see we're also very overbought on the 4-hour period. We hit overbought multiple times. We hit it once here, twice again here. When we start to enter into overbought and oversold territory multiple times, that's when those really get my attention on the RSI. And that was one of the thesis behind entering that short position there. But another thing that we really need to be cautious of, if you take a look over the week, this is the government auctions for treasuries and T-bills and bonds and such. And you can see, really just in the first few days of the market, this doesn't even go all the way down to the 10th. We have 330 billion. Now, that 330 billion is simply calculated from the amount all highlighted with red arrows. We have 75 billion in 13-week bills being auctioned off, 68 billion in 26-week bills being auctioned off, 75 billion in the 42-day, 48 billion in the 3-year notes. Then we have 40 billion in the 10-year notes. This is going to be on the 8th at 1 p.m. So pay attention on the 8th at 1 p.m. This is going to affect the movement of the 10-year treasury yield, depending on how the auction goes. If it goes good or bad, you could see a pretty significant move in the treasury market. And lately, one of the factors that has been pushing and driving the momentum in the S&P 500 has been treasury yields falling. Okay. And then over here on the 9th at 1 p.m., we have longer term bonds. We have the 30-year bond auction selling 24 billion on the 9th at 1 p.m. So, that 330 billion is just calculated from these that are added up, and the rest is not even disclosed. So, I mean, if we were to just be generous and say it's only like another 100 billion, which is funny to say only another 100 billion, I mean, that puts us very close to $500 billion of auctions literally just being auctioned off, or treasuries and bonds and T-bills being auctioned off just this week alone, which is absolutely insane. Now, anything Jan can do better. And so when they say Jay, they're talking about Jay Powell. And when they say Jan, they're talking about Jan Yellen. All right. And so amid heavy news flow, the 10-year yields fell 15 basis points in 7 hours. Okay. And so this was the Treasury funding announcement. And so basically they announced that they're not going to sell and issue, as much treasuries as the market anticipated. Now, it wasn't really a big drastic difference. Okay. It came in slightly lower, and mostly lower on the long end, which the market liked a lot. And that's why we saw a dramatic drop in the treasury yields. And this is why, I mean, it could have been a little bit of an overreaction when we took a look at that TLT chart and went from 81-ish, 82-ish up to 89 very, very, very quickly. And the bond market's extremely volatile. And, we could have seen a little bit of a dead cat bounce, right? Maybe it was just an overreaction to the downside initially. And now, we get some good news for the treasury markets and we see a little bit of an overreaction to the upside. We just need to be cautious that it's not a dead cat bounce. Remember, in my last few videos, I've said that really between 82 and 89, that's my consolidation zone, right? I think that's very possible that that could be the new range for TLT until we get some further clarity in the actual direction of interest rates and, regarding the Fed fund rate as well. I mean, they're pretty much just holding right now. So we didn't get really necessarily hawkish news that they're going to continue hiking. They also said that they don't see a recession anymore. That can change on the flip of a coin. That can change very quickly. So we are getting some good news, regarding the economy and helping the bond market out. But ultimately, there's still a massive supply issue, in my opinion. And I think until we get some further clarity and until we can start trading above $89 and flip 89 to support from resistance, I think it's very possible we range on TLT, all right, in that zone between $80 and $89 for the forthcoming future. Now, the return of bond vigilantes. Okay, now this is a term that I had to learn about, a few months ago, earlier in the year, because I was not around when the original bond vigilantes came out. But the yield curve has flattened on the back of higher long-term rates. So usually, when you get an inverted yield curve, what happens is the yield curve uninverts whenever the shorter term duration bonds, all right, and shorter term treasuries, when those rates start to decline, right? Because the whole reason it's inverted is because you can get a higher yield on shorter term than you can on the longer term. And what we've seen is we've really not seen much of a decline in the shorter term. Okay. What we've actually seen is just a meaningful incline of the longer term. And the longer term has just been extremely bullish up until, the news last week. And that is one of the main factors that really caused the yield curve to start to flatten and uninvert, was not so much that short-term treasury yields are declining, but actually that the long-term yields are just outpacing the rise in short-term treasuries. Now, the market saw a gamma squeeze last week. What we're taking a look is the gamma history for the SPX right here. And so when it's green up here, this is positive gamma, right? When it's blue down here, it's negative gamma. And I just want you guys to take a look at, the huge amount of negative gamma. This is the lowest levels we've seen, okay? I mean, we were at extremely low levels here. We had reached those in October. And very quickly, okay, in 1 week, basically, we went from negative gamma to positive gamma, and that ended up causing a gamma squeeze. Okay, so basically with gamma, not to get too deep into it, but market makers, they have to buy and sell, shares, okay, and basically go long, go net short, a position on shares or futures or things like that, based on the type of contracts being executed, right? So if they're selling you guys a bunch of call options, right, and let's say a bunch of people are buying call options and market makers are selling those to you, well, to hedge themselves, they're going to buy the underlying security, right? Versus, if people are buying a bunch of short contracts, what's going to happen is the market makers are going to hedge themselves by going short the underlying security as well. So, when we saw this massive amount of negative gamma here, it's no surprise that we also saw the S&P 500 extremely bearish. And in a very quick amount of time, we saw a gamma squeeze and go from negative to positive gamma right here very quickly. Now, investors have often seen positive returns in the S&P 500 index across 1 month, 3 month, 6 month, and 12-month periods, following this breadth thrust signal that we've seen since World War II. Okay. And so, the gains have been very, very impressive. The smallest gains have been, where is it? In the 12-month period has been basically 6.9%, 9.1%, and 7%. Everything else there has been double digits, with only a few of them being around 17, and 15%. The rest have been 20% or more. Right. And so if this signal is going to play out, basically it could mean that by this time next year, roughly this time next year, we're going to be seeing some pretty impressive returns in the stock market. And, you can see this also plays out to 6-month returns, basically 6 months to 12 months out in time, we're green 100% of the time based off of this signal. 3 months out of the time, there's been a few times where we've been red, and 1 month out of this data set, there's only been 1 month where we've been red. So I mean, if you take into account all of this, right, there's only been 5 periods in a 1 month, 3 month, 6 month, and 12-month period after this signal where the market has actually been red. And 100% of the time, 6 to 12 months out, the market has actually been green. So we'll see how this data plays out in the future. Just because something's worked in the past doesn't mean it has to work in the future, but I really enjoy seeing data like this and taking this stuff into account, whenever I'm looking at the market. Hopefully you guys do too. This is the recovery time from stock market drops from 1945 to 2021. If you take a look at the type of decline, so a pullback is anywhere from 5% to under 10%. A correction is 10% to right under 20%. And then a bear market is 20% or more. A garden variety bear market is 20 to 40%. And a mega meltdown is anything over 40%. So we had a garden variety bear market last year. All right. A 20% decline. And most recently we've came into that correction territory. Okay. We basically got to that 9 to 10% correction in the stock market. And so the recovery time, right, is typically about 1.5 months to 4 months. Right. And so your average drop from the peak was 7% and 14% for these two study sets. All right. But what I want to show you guys is there's been plenty of declines like this, plenty of pullbacks that we have in the market. This is 60 right here. We basically get one a year. I mean, if you basically, just kind of look at that, we essentially kind of get one a year almost roughly. And so we definitely did experience a very strong pullback in the market here and did dip into that correction territory. And so it could take 1.5 months or it could take 4 months for us to, recover from those and essentially get back to the previous highs that we were at right around that 4,600 area. So we'll have to see, how this data set is going to play out. And this kind of is important to the year-end rally type of data set. If we only experience that pullback and if we kind of go off this data set, then we would look for 1.5 months to recover and get back to those previous highs that we were at. And that would be a little bit more supportive of the year-end rally versus a correction. It's very possible that it could take up to 4 months, which would put us into, January, February for that recovery period to get back to those previous highs. Now, 4,400 is the call wall. Okay, this is on Bloomberg. All right, and we're looking at the gamma levels here, and basically right around 4,400. All right, is going to be the largest exposure for calls. Right, white line is calls, purple line is puts. That is going to be your call wall, essentially, right there. Okay, and what this means is that this is going to be a tough area for the market to get over, and this could be an area where the market gets stuck at. Right, if we do end up rallying to 4,400 on the SPX. It's very possible that that's an area where the market gets stuck at. And in my opinion, it really wouldn't surprise me if we get up to that 4,400, get near that 4,400, somewhere around there, and then we start to experience a little bit more of a pullback afterwards. Okay, because last week was an extremely rare move where we actually went double the expected move. Okay, and so we won't dive too much into what the expected move is, but that's calculated every single week for you guys. And you can see basically what the markets are pricing in for the market to go up or down. And we went twice as far as the expected move to the upside was. That's a very, very rare occurrence. It was a great opportunity to make money if you happen to be long in the market and were able to spot some of the other signals from the previous week before that that I covered in the video, looking underneath the hood of the market, going into some of the internals. And then by the third day, by Wednesday, we had 3 white soldiers on the daily chart pattern for the S&P 500, which is a bullish candlestick pattern. We gapped up over the 200-day moving average after that. And then, a lot of the news and other things behind that really helped fuel the rally too, on top of the gamma squeeze. Now, market sentiment and positioning in the Treasury futures market is still bearish. So we're looking at the 10-year up here. And essentially what we're seeing here is we're still seeing a way more short positioning right now. Some of it has started to cover here recently, right? And you can see a decline in the short positioning. But overall, I mean, don't fool yourselves. The Wall Street hedge funds and everything, they're still overall bearish on treasuries. And there's a few reasons for that I've covered in many videos in the past. We won't dive too much into it. But let's go ahead and dive into the four pillars now. Okay. And so the four pillars, all right, are going to be XLK, SMH, XLI, and XHB. The reason these are the four pillars is for the market to see a true rally and to see true confluence in the market to suggest a support of the move. These four things need to be moving in the same direction. Okay. And really, since the peak of the market in the summer, what we've seen is that all of these have just been trapped in overhead supply, right? Trapped by overhead supply, trapped by overhead supply, trapped by overhead supply, and trapped by overhead supply, and they all declined. Now, XLI, okay, industrials and home builders, XHB, these two were the weakest, right? And we saw these break down before tech. You can see tech, XLK, and also SMH, the semiconductors, they were holding their support levels pretty well. All right. Meanwhile, the XLI industrials and home builders broke down, right? And this was a key sign to the market that, hey, two of the four pillars are breaking down right here. This is not a good sign for the market. And we could be, seeing some downside movement in the market. And if we take a look at where we're at right now, basically 2 out of 4, right? So our tech right here and our home and our semiconductors, they're on the verge. They're testing their breakout trend lines right now, right? So if these two can break out of their trend lines, then that could help support the market rally even further. But when you take a look down here, we see home builders already broke out, right? So, 1 out of 4 has broken out, right? We would look for, tech and also the semiconductors to break out to give us 3 out of 4 breaking out. And really, the most important sector, in my opinion, to watch over the coming weeks is going to be XLI, your industrials. The industrials have been extremely weak. And if these can rally and break out as well, then we should see the overall market performing very well because the four pillars are all breaking out from their downtrends, right? Now, when we go to a daily chart, there's still a little bit of cause of concern. If you take a look, XLI and also XHB, they had these gaps down to fill, right? They had these gaps down to fill. XLI filled its gap. XHB came down and filled its gap. But we never saw the semiconductors come down and fill their gap, right? They basically found support right along the top of the gap, as you can see there. And then we did not also see tech come down and fill its gap. So, the thing we do need to be cautious of on the daily time frame is, 2 out of 4 of these have gaps to fill. They are above support. Both of them are above support, but they also gapped up above support. There's a gap there and there's a gap there. If these things start to reverse and break through support, we need to be cautious of these gap fills, on tech and on the semiconductors. But the thing that looks nice is that, 2 out of 4 of them, as I mentioned, XLI and XHB, they already filled their gaps and they had a very, very strong recovery afterwards. So if they can keep up that momentum, and really we want to see XLI. I mean, if you look at that downtrend, it's just been absolutely brutal. And it's nowhere near as close to breaking out as we mentioned as the XLK. SMH and the XHB already has broken out of its downtrend. So that's what we're going to look for and pay attention to. I think industrials are going to be very important to pay attention to, in the nearer term future. If we look at our risk on ETF versus our risk off, we have risk on up top, which is an ETF comprised of copper, high yield bonds, the Aussie dollar, semiconductors, and high beta. This is trying to break out right now, currently, literally trying to break out right now. A couple weeks ago, we talked about how a lot of the bearish moves in the market made sense because our risk off ETF comprised of gold, US Treasury bonds, yen, utilities, and staples was actually breaking out here. But what we can see, we did not get any follow through, right? So we got the initial breakout, and since that breakout, it's actually started to pull back. So if this turns into a look above and fail, that's good. That could potentially be bullish for the stock market, especially if we see risk on continue to break out. Now, if this rejects, okay, and this bounces off of this area here, then that's going to be more of a sign that the market is going risk off versus risk on. And continue to potentially keep its downtrend intact with the S&P 500 right here putting in a lower high, also very near its trend line here as well. If we take a look at this is a measurement I use to go to basically measure if the market is defensive or offensive. We've got the S&P 500 here on top. We've got a high beta versus low volatility ratio, consumer discretionary versus consumer staples ratio. We've got a ratio of credit spreads right here in biotech. And this looks really good, right? The market was fully offensive last week, right? We had 4 out of 4 were all up, right? We saw an uptick in the high beta, discretionary, credit spreads, and the biotech. Biotech is the one that I've mentioned that we really needed to see some follow through with. The previous week before, we had 2 out of 4 going bullish, right? Biotech was not bullish, and the high beta was not bullish, but consumer discretionaries and credit spreads were leaning up a little bit more and giving us a hint that, hey, if we can get some follow through from the other two here, we could see some bullish momentum in the stock market afterwards. Now, all of those charts that I went over, those Thinkorswim charts right here, these are all mine that I've basically come up with over time. They're actually available to you guys via Thinkorswim. You can use the flexible grid feature and share flexible grids. And I have many, many flexible grids, even more than we went over in this video, available to all of the Discord members. So, remember, we talked about the investment intelligence Discord. We get access to all of the different trade ideas, but there's many more things in there. There's custom scripts, custom scans, as well as the many different flexible grids. Okay, so don't forget to sign up for that if you guys want to. If not, you can always sign up for the the free newsletter, giving out 1 to 2 free trade ideas a week, such as this one on SWK, Stanley Black and Decker, highlighting the rising wedge, giving the targets to the downside. That one played out very nicely. And if you want to see the plays, and these are a lot of the plays that we were in last week. Tesla, ExxonMobil had a very clean double bottom. Apple, Carnival Cruise and Etsy, we got in a little bit before. NU has been a sleeper. Nobody knows about that one. SHY, SPY, Tesla. A lot of these plays we sold. SPY ended up selling for 198%. Tesla ended up selling for 100%. Join the Discord. Okay, there's a link in the description. It costs less than a cup of coffee per week. All right. And we'd love to see you guys in there. All right. Remember as well, if you do want that one-on-one coaching session, one-on-one personal touch, you feel like, you need that interaction to be able to ask some questions or just figure some things out. You can always reach out to me on the Ko-Fi page using the link in the description and buy a 30-minute or a 1-hour coaching session.